Okay, so we just have to finalize. We had a statement of financial position, right? We had the first note here, right? And I think we went all the way up to note 2. We just said that we left one thing. We had left one thing here, which we said we'll come
Yes,
back.
the 1 million.
Yes, of issuing shares, right? And we said that it is about equity financial instruments and so on. But I think it's just something normal, so you can just deal with it, right? Whenever you're doing this, even we started under consolidation and we say that professional costs should be expensed, but if those costs are associated with the issuing of bonds or equity, then they should be treated as a financial instrument. And in this case, when you encounter something like this, you would have, instead of expensing this cost, you have to deduct it from equity, right?
Okay.
Yes, because you have issued shares, they will be having your equity. So what you're going to do is you're just going to deduct it from equity. Which equity? Not very specific. So you deduct it under other components of what? Equity. So it's all
Okay.
1 million, yes. So you could have just come here and say,
There you've gone.
okay, let's make a work, let's create a working. We had the working for due diligence there, and then working 7 or equity, other equity investments. We could say, we could call it working 8, right?
Yes.
Yes, so let's say maybe we have working 8 here, and we say it's cost of issue. Cost of what?
Of issue.
Issue. We can just say that. It was worth 1 million, so it's like 1,000. Okay. We were told that it was part of investment cost, which was wrong. It means it had been capitalized, right?
Yes.
We just need to remove it from that capitalization. So we would say credit. Credit what?
Investment capitalization.
And it was the investment in beta, just like the due diligence, right? Beta of the subsidiary. So we credit 1,000, and then we have to go and debit it under other components of what? Of equity. So you say debit other component of what? Of
Bit.
yes, by 1,000. Right. So let's finalize with that too. So we credit investment in beta. And if you go to the statement of financial position, I told that you need to know how this investment usually cancels out. So I would say investment in beta, I would deduct that 1,000, right?
Yes.
And then you come to the actual.
They say 10,000.
I wrote 10,000.
Yes.
Okay. Yes, it's 1,000. And then you see it has become 0. So I was doing this. That's why you have told that you don't have to show this. But you can act as if you are showing it so that sometimes they combine even these other equity investments, they combine them here. And they tell you what remained with the other equity investment. So if you use this approach, whatever you remain with, you would say, okay, maybe this was the investment in other equity what? Okay.
Okay.
It's just like that. Let's close this. Yes. In the other side, we said we go and debit other components of what? Of equity. Right. I think
Yes.
component of equity, because this is about the parent. So you go to group equity. Group equity, on group equity, we had group retained earnings and group's other components of what? Of equity. Right.
Yes.
Yes. This friend of mine is calling now. No, there's my friend. Okay. My friend overseas is working, so he wanted us to talk today. Okay,
Okay.
let's just go on. At this 40 minutes, I think I will call him. Okay, so on the group, other components of equity, we can go on and deduct this, right?
Okay.
So you can start with the parent what? Parents. Just like for group retained earnings, you start with the parents, other component of equity, you take it down, right? And then you
Yes.
proceed If maybe you had, I could say this, just like we did on other on retained earning, good retained earning, you also take the 75 per what percent times post acquisition reserve, but for something related to other components of what of equity, it may be there or it may not be there. Right, that's common. You should always do it. And then
Okay.
what we said, we were talking of cost of issue, cost of what of
Issue.
Yes, you debit it. So if you debit it, of course, it should be like negative, right? Because it's going
Yes.
to equity. Here it was negative 1,000. Let me just write 1,000 there without reference. You do that, right? Then
Yes.
it would be fine on the first note. So I think we are done with the exhibition 2.
Yes.
Exhibition, I may close this and let me go to exhibition 3. Go to exhibition 3. We also read this that day. We say that alpha, can you see properly? Or maybe I should enlarge this, right? I hope you can
Yes.
see.
Yes, I
Okay,
can see.
Alpha was a parent. Alpha provides better with management services and levies a monthly charge for these services, right? Just like
Yes.
group trading or maybe like people, maybe they may have intergroup loans or what. On 29 September 2027, remember the year was ending 30 September 2027. So on 29 September, it was one day before the year end, right? Beta made a payment of $8 million to Alpha to eliminate the amount owing to Alpha at that date. Of course, Alpha is like a supplier and Beta is like a what? A
A
customer, right?
client.
It's a
Yes.
fine. So, seeing that Beta had paid this amount of money, and you are told this payment was received and recorded by Alpha on 2nd October, it means by the year end, it was something that had been paid already a day before, but it had yet to reach in the hands of what? The hands of what?
Alpha.
Of Alpha, yes. So that's the cash in transit. So we presume that what would have happened had Alpha received this, right?
Yes.
So we go for the cash in transit. Okay, we have to create another working, eh?
Yes.
It was
For
working
profit. For PUR.
provision for realize the profit. Okay, you know I like the way you called it. There you are now. Look. Here we say this is the cash. We speak of the cash in transit, not the not PRP. PRP, the
Oh,
provision is the profit. It shows that some goods or services were sold or provided, right?
yes.
And those goods were yet to be sold. This doesn't speak of that. It just tells you
Okay.
cash that had been paid and it had yet to reach the hands of the supplier. It's not goods
Okay.
cash in transit. You have to differentiate. We have goods in transit. For goods in transit, we could have said, okay, maybe in case we are dealing with not services, maybe it was goods, right? And maybe
Yes.
Alpha had sent the goods, but the goods had yet to reach better by the year
Better.
end. You could have said that was
Oh,
goods in transit, and it would have had the provision for the profit in full, 100% of it, right?
okay.
Yes,
Okay. I
that is
see.
transit.
Okay.
Yes. So we say that cash in what?
In transit.
Yes, good. So this is the cash in transit. By the cash in transit, who has not recognized this? The supplier or the customer? If it's a cash in
It's
transit,
the supplier.
great. If you mean the customer has paid, the customer who pays, the customer
So
has paid.
you've gone.
I do mean is it means that the customer has paid, but it is yet to reach the supplier's hands, right?
Yes, sir.
So what we do, we say that in case Alpha had received, we would have debited, would have done what?
Cash.
Eh,
You have been debited cash.
Yes, cash. By how much? It was 8 million. So let's put 8,000 here, right?
Yes.
8,000, and then we would have credited. Okay. It means if Alpha was yet to receive, it means Alpha had the receivables right in the books.
Receivables, yes.
So the
Yes, sir.
receivables are going to be reduced, right? I would say
Yeah.
trade what?
Receivables.
Yes, just like that, by the same amount, which was 8,000, right?
Yes.
You see now this how simple this question was. The first question we did, it had the cash in transit, it had the goods in
And good.
transit,
Yes.
had the
Yes.
intra-group. So it
It
was,
makes it.
and it had two ways, two types of goods in transit. Sorry, it had two types of provision for analyze the profit. One was for goods in transit, the goods which were yet to be received, but the other was for goods which had been delivered already, but part of them
Yeah.
yet to be sold. So it had a lot of complications.
Yes, yes, sir.
Yes, but in an exam, you find something like this. It's very direct. So let's just go on and direct this. And as for trade receivables, you don't need to say, okay, this is for parent or this is for subsidiary. Because remember, when you do consolidate, we usually add the assets and the liabilities. So you don't have to say, okay, this belongs to this or this belongs to this, right?
Yes, sir.
Yes. Okay. So let's go to the books and we have to debit the cash. Cash. Okay, cash should be on the current assets. Had you established that anywhere? No. Okay.
Not yet.
You just choose anywhere. The good thing about this sheet, you just decide to choose wherever you want.
Okay.
Yes, let's say maybe I want to put it this here. I would say cash. Okay, I don't know. I don't know. Maybe in the books we already have another cash. It's 8,000. 8,000, right? And then
Yes.
I would come here too and write equals to, and then I write there 8,000, just like that.
Okay.
Okay, it's your choice if you want to go to the statement of financial position and finish off everything, but I want us to do this first, okay? And let's finish up with the other entry. It's a trade receivables, we credit it by 8,000. So, of course, let's say maybe we have the trade receivables here. Okay, I think
Yeah.
it's better to know how it has been written, right? Let's see how this has been written in the books. Trade receivable. Okay, it has written trade receivable the same way,
Then,
right? And here we have
yes.
cash and cash equivalent. So we could have said that let's call this cash and cash what?
Equivalent.
Okay, above here we have trade what? Trade,
Receivables.
yes. Trade receivables, it was 8,000. We are going to deduct. To deduct how much? 8,000, right? Yes.
Yes.
And here we say equals to, and then we say -8, because you're going to deduct -8,000, right? Because you're going to deduct it, right? Is that fine?
Yes.
Okay, so I think after here, what else do we have? Okay, we still have the other
We,
thing, the share-based
we
payment.
added
Oh,
on
yeah,
this on the draft, we don't have amounts
we have. We just put
that we
that.
need to add.
Yes, we'll just finalize with that. We'll just copy it, no problem.
Okay.
When I do this question, I like to presume that we may encounter something else. So
Okay.
let's do the things that are not in the books. Whatever is in the books, it will be just
Okay.
simple to incorporate. Yes. So let's
Okay,
go
sir.
to the last exhibition. And here we are on the last exhibition. Last exhibition. Let's see this. Let me expand it.
Okay.
Yes. You haven't gone through this, but it's very, very simple. Just do it.
Okay.
Yes, and it will be fine. It's like the taxes. We did it that way on the deferred tax, but you started learning something. Okay, so we are told here on 1st October 20x5, Alpha granted 2,000 senior managers options to buy 100,000 shares each between 30 September 2028 and 31st December 2028. So the grant, the decision was on 1st October 2025, right? But people would be able to have those options 3 years later. You see, from 30 September.
Yes.
Yes, but actually, maybe after 3 years, they had the chance from 30 September to 31st December. It means they should have done it in 3 months' time. Okay. Options are due to vest on 30 September 2028. By the way, the options are due to vest, it means maybe we entered into an agreement today, but for you to have these options, you have to stay with us from 1st October 2025 to 30 September 2028. It means you have to stay with us for 3 years, right? So
Okay.
that's why when we speak of this, just not this now. Here we are speaking of IFRS 2 share-based what? Share-based payment. You will get that standard share-based payment, right? We normally have two ways of paying. Instead of paying the cash direct, right? We say we have two ways. We say that we have something, a scheme called equity settled. You settle by equity, or we settle by
Okay.
cash settled, right?
Okay.
Now, you ask yourself, if you're speaking on that, why are we mentioning cash again? When we say equity settled, we just mean a very simple thing. By equity settled, we just mean that you're not going to, you just form equity first. You just call something equity, after which, maybe after this will be the grant date now. The date you enter into an agreement is called the grant what? The grant
Date.
date. And then the date, maybe you have stayed for 3 years. After those 3 years, we call that the vesting date. So between the grant date and the vesting date, we call that the vesting period. Okay, you have to stay with us for a vesting period of 3 years, be able to have those options, right?
Yes.
Yes. So you can have the equity settled share-based payment, but also the cash settled share-based what? Payment. If you are told equity settled, it means you first record equity in form of other components of equity. And then when the vesting date arrives, and when you exercise the share options, for example, you will have the actual shares. So you will convert these other components of equity to the share capital, right? But when it is cash settled, it means instead of recording the equity, you will be recording the liability, right? And then you record the liability for the first year, the second year, and the third year, after which point, the liability should be settled in cash, right? It would be settled in what?
Yes.
Cash.
In cash.
So at the end, instead of saying for equity here, you'll come and convert it to share what? Share capital. But for cash settled share-based payments, you'll convert it, you'll just have to pay it. To pay the what? The cash to settle. Yes. So that's the main difference, but it's no big deal. Their questions, they are very simple and very direct. And you can even see at the beginning when you do it, it will be like you won't notice. You just have to notice very little matters. Let's take a look at this and you understand, right? So
Okay.
whenever you deal with this, we just need to know how many options you expect to be available after 3 years, right? I mean, at
Okay.
the end of each year, because you have been told that you have to stay for 3 years. But what we do is we say, after 1 year, how will the situation be? After 2 years, how will the situation be? And after 3 years, how will the situation be? You don't wait for 3 whole years to do that. And that's why the standard was established, because previously this wasn't being recorded. They were leaving it until after those 3 years. But right now, at the end of each year, we have to recognize that, right? So you can, on 1st October, Alpha granted how many? 200.
200.
Yes, it's simple. Let's start it this way. Let's start as if you're not doing that. This was working 9. You could say now working how much? Working 10. Let me just share based payment SBP, right? So this is the first thing that you will have to do. Let's just do it in a very simple way. How many managers? 200?
200.
Just like that, right? What we need is not the number of managers. We just need to know the number of options, okay? Granted 200 senior managers options to to buy 100,000 shares each. 100,000 shares each. So it means we have 200 managers, and each manager is expected to buy how many shares? 100.
100.
So it's
100.
100,000 share options. I could just write there options. It means share options. 100 what? Options are what? Per manager. So for each manager, if each manager buys this one, it means if we multiply this, we'll get the total options, right? In case all 200 managers exercise. So this gives us a total number of what? Of options. Because manager here and manager here will cancel out, right? So we'll have a total number of options. Okay. Going on now, we are told about these vesting issues and what? We are okay. We have been told that it would vest on 30 September 2028, provided that the relevant managers remain employed over the 3-year vesting period. That's why you can see this the word 3 years. It means it is from 1st October 20x5 to 30 September 20x8. Right. Yes. Okay. Since 1st October 20x5 now, since that date, which is a grant date, the expectation of the number of managers in whom the options would vest has varied as follows. You see now, you provide this option to 200 managers, but it will only work for those who will be at the company for 3 whole years, right? So
Yes.
what you need to do is you account for that at the end of each year. This is 1st October 2025. After 1 year, it means it will be 30 September 2026, right? Yeah.
Yeah.
Then the second year, it will be 30 September 2027. And we have it
There
here.
you go.
Second year would be 30 September 20x7. And the third year
Yes.
should be September 20x8. But I think they have stopped at 20x7 because this is the year end, right?
Yes.
So this is what you should have done. If you find something like this, it means at the end of year 1, which is this one now, the number of managers expected, expect number of managers for whom the options will vest. We only expect 180, not 200, right? Not what?
Yes.
200.
Not
So you can
one.
picture and we can say, okay, let's write down here. Let's say we have, it is 30 September, right? 20x6. We have 30 September, 20x what? X7, right?
Yes.
So 20x6, this is what we should have done. We should have done this. Instead of 200 now, we only expect 180, right? Multiply.
Yes.
Number of options per manager is 100,000. So here we'll be having the total number of options, right? But what
Yes.
the weight of those options? So to have the weight of those options, we usually multiply by something called the fair value of those options at grant date. So when you do the equity settled share-based payments, right? This is an equity settled share-based payment. I'll tell you why, right?
Okay.
This in equity, we'll come and learn what the cash settled share-based payment is. But this, simply speaking, it is the equity settled share-based what? Payment. For equity settled share-based payment, we usually multiply by the fair value at the grant date. And the grant date, like I told you, it is this date of agreement, right? 1st October.
Okay.
So if you go on reading, we are told in preparing the financial statements of Alpha for the year ended 30 September 2026, which is the first year now, from what? From the grant date, the directors of Alpha debited retained earnings and they credited other component of equity. This is usually done. I will tell you, I will show you, no problem, with the appropriate amount required by IFRS share-based payment. So the first year the entries were made, no problem. The directors of Alpha have made no additional entries in respect of this arrangement in the draft financial statements for the year ended what? That is September 2027. So the entries for the second year have not been made, and that's what we want, right?
Okay.
Lastly, we are told on 1st October 2025 now, which was the grant date, the fair value of the options was how much? $1.2. This is what we should use, right?
Okay.
The fair value
Yes.
of the same options at 30 September 2026, you see, in 2027, we also have different values.
1.5. Yes.
When dealing with
Okay.
when dealing with the cash settled share-based payments, we have to know because we are going to settle with the cash. So we need to consider the changes in the fair values of options, right? But this is equity settled share-based payment, so we don't care about the changes in the fair value of options. We use the same value at the grant date, which is 1.2, right?
For
So
three, for both three,
1.2, it was
for 3
1.2.
years.
Yeah, for all 3 years, the first year we'll do the same, the second year the same, and the third year the same. We won't change. Yes, right.
But if it was cash based, we're supposed to be changing according to the fair value.
We'll be taking the fair value at the end of each year. So if in case it was the
Okay.
share-based payment, in case it was the cash settled share-based payment, it means even here 26, I would have used the 1.25. 27, I
Okay.
would have used 1.3. You see that?
Okay.
We're going to settle any cash. If you are going to settle any cash, it means the actual money is going to be given out. So you have to really comply with the fair value is at a particular date, right?
Okay.
Yes. So you multiply by 1.2. And remember, when we speak of 180 after 1 year, we don't mean the number of directors, the number of managers who will still be available after 1 year. No, we don't mean that. We mean after, we predict. We say that, okay, after initially, I gave this to 200 managers. So, of course, I could say that at the beginning, I expected all of them to be available. But that's why you can see 1st October, we expected all of them to be available, right? But after 1 year, you say,
Yes.
oh, maybe some had even well, you don't know, you won't know. Maybe 10 had left, for example, and maybe they expected 10 more to leave for the remaining period.
Okay.
So that would give a total of 20. That's why we say we expected one what? 180. Right. Yes. So this is for whole
How
3 years.
possible? How
Yeah.
possible is it that they predicted the 20x60 to for 180 managers to remain, and then the following year 190?
Yes, that's why I'm saying whenever you see this 180, we don't mean by the end of year one, we don't mean that those who have left in year one. No. This one is the people the managers who would have remained over the entire 3 years.
Ah, okay.
Let me show you here. For example, let me tell you, we had 200, right? Maybe
Yes, sir.
in the first year, 5 have actually left. And the first year has ended. 5 have actually left. But it's not like I say we have 195. We don't mention the number which has remained after 1 year. No. We mean the number which we expect to have over the entire 3 year period. So we would have said,
Okay.
okay,
Okay.
in the first year, 5 have left, but we expect that the second and the third year 15 more are going to leave. You see, so 200
Okay.
minus 5 minus 15 gives you one what? 180. You see,
180.
that's why the
Yes.
second year you wondered, okay, we would have said this, okay, maybe the first year 5 had actually left, we are sure of that, right? And maybe in the second year and third year, we expected the certain number to leave, but maybe we say that 5 have left. In the second year, let's say only 2 have left, right?
Yes.
But we say that, okay, in the second year, 2 have left. We only remain with 1 year, right? And maybe
Yes.
they tell you for this remaining year, it means in the first year, we are sure 5 have left. In the second year, we are sure 2 have left. So a total of 7 have left, but we still have 1 year. And then we say, okay, for the remaining 1 year, we expect a further 3 to leave. So okay, if you say you expect further 3 to leave, you say 200 minus 5 minus 2 minus 3, you get 190. That's why it will just change. You take the best estimate available at the time, right?
Okay.
Because
Okay,
one
sir.
part would be real and the other would be an estimation. So it will.
Okay.
Yes.
Okay.
So
Now I
after this,
understand.
okay, so you multiply. That's why after multiplying these ones, we usually have to come and multiply. This is we have 3 years, and this is the first year. You have to multiply by 1/3. You see that? This is the reason
Okay.
we do this, because this is for the whole 3 years. So you have to apportion, right? And the other thing now that you need to know that is very important here, we usually write the word what? Equity, or simply speaking, other components of what? Of equity. And the remaining usually form the part of an expense. Part of what? An expense.
And
But here now, we do not have one. It is either an expense or an asset. But you know, we don't have an asset there. And since you're not dealing with the income statement, that's why we use the retained what? Retained
thank
earnings.
you.
Yes. So what we do, you know, to get this, we just take the difference. Okay, or maybe just leave this. Let's proceed. For the second year, we'll do the same, right? So we would say for the second year, we said we expect to have 190, right? Times
Yes,
number of options, 100,000, and then times what? Times
1.2.
1.2, and then this is the second year, so you multiply by 2/3. You see that? Yes.
Yes.
And to simplify matters, like I told you, we say you need to hold the 3 zeros up, so you could just delete. Let me remove the 3 zeros, yeah?
Okay.
Just like that. So we'd be having our equity just like that. So after here, to get, you know, if you can understand now, for IS 12 income taxes and this share-based payment, we start getting the figures in the statement of financial position, which are usually the accumulations instead of the income statement first. So we usually start with the statement of financial what? Position. So if you need to know the expense here, it's simple. You take this equity and you deduct the previous equity, right? So you can see this equity is 7,200. The previous equity, there was nothing in this entry. So that's why they would be the same, right? And then
Yes.
when you come to the second year too, you take the equity for second year and you minus the previous equity, which is 7,200. You see that?
Yes.
So the exam told us that the entries for the first year had been entered, so we don't have to deal with them. So we only have to add the entries for the second what? For the second year, right? So you can see,
Yes.
okay, so the equity for the second year was this one, and for the first was this. By how much the equity increased? The equity increased by 8,000, right?
8,000.
So since
Yes.
it increased by 8,000, you say we just go, we just have to go and wait.